It's watch market update time. We've got no crypto bros hoarding Rolex Daytonas as asset classes. We've got tariffs that are making everything super complicated. A lot of companies that do report their numbers are still having a tough time, while others seem to be going gangbusters in terms of performance. Is now the time to pick up a grey market speedy at 50% off? Or do we wait 6 months? And where are we headed in general? Let's dive in. You probably know this by now. A lot of watch companies don't share their financial data. They're actually a little bit stingy when it comes to saying how they're doing. But the conglomerates do. Legally, they have to report their performance. So we've got LVMH, Richemont, Swatch Group, and Seiko. LVMH, from their 2025 first half results, they said solid demand in the US and Europe, tourist spending affected by currency fluctuations, uncertain economic environment. For watches and jewelry, they were down 1% compared to the same time the year before, which was also not a great year. Profit was down 13%. Overall, they were generally pessimistic about the outlook for this part of their business. Richemont, jewelry did well, including Cartier, and that also included Cartier's watch division. Their specialist watchmakers were 7% lower than Q1 of 2024. This was mainly because of a decline in Asia. The Americas broadly had double-digit growth. For Swatch Group, the first half of 2025, sales were down 7%. Operating profit was so bad that they barely made a profit. The decline is, according to them, exclusively attributable to China. North America, India, Turkey, Middle East, and Indonesia all grew. Omega, Longines, Tissot, Hamilton, Swatch all did really well in the US with between 10 and 30% growth. According to Swatch, the main reason they had a bad result was because, and I quote, strongly negative operating result in the production segment due to the strategically and deliberately maintaining of production capacities and jobs in Switzerland. So basically what they said was the people that make the stuff that goes into the watches were not fired, which they probably should have been if we wanted to make a profit. As for the 10 to 30% increase, we have to remember that one of the things that happened prior to tariffs is a lot of companies imported a ton of stock to the US to make sure that they had money in country before the tariffs kicked in. And since Swatch Group is a wholesaler, that's what's happened. It doesn't mean they've sold 30% more watches to customers in the US. It means they imported 30% more watches in the hope that they would sell them. That's not necessarily a good sign. Seiko had a first half of 2025 which improved by 7.4% compared to 2024, from 44 billion yen to 47 billion yen. The growth was driven by domestic growth for Grand Seiko and global growth for Seiko Prospex and Presage lines. Interestingly, despite growth in the US, they still view the results as sluggish. Their outlook is that 2025 is going to be a year with overall improvement compared to 2024. If you are new to this channel, then I hope you consider subscribing. It helps out the channel massively, and it also helps you out because then you know when I put out a new video. Thanks a ton. Now, I also spoke to a couple of direct-to-consumer brands, including Christopher Ward, and I think the most important takeaway from these kinds of brands is the following. They've seen a lot of growth, especially because they've been focusing on the West and Europe. The downturn in Asia just isn't really affecting them in any meaningful way. But the moment they saw a 39% tariff kick in, their sales tanked. Some of them, like Christopher Ward, have managed to restructure the way they get their products into the country, the US, which has meant that it's no longer a direct 39% tariff on the MSRP for direct-to-consumer businesses. Sales have largely rebounded to previous levels once they figured this out. Then there's the Federation of the Swiss Watch Industry. They say the following. Swiss watch exports returned to growth in July, boosted by the uncertainty surrounded by US tariffs. Exports increased by 6.9% year on year to almost 2.4 billion francs. However, excluding the impact of exports to the United States, they would have decreased by 0.9%. Basically, they would have been down if it wasn't for the US, but part of the US performance is also down to the fact that a lot of suppliers shipped a ton of product to the US prior to the new tariffs coming into place. What you have to be mindful of is that most of these brands function as wholesalers. So when they're doing well, it doesn't necessarily mean customers are buying a lot of watches. It means they've sold a lot of watches to middlemen. And that's what they did in April and May. They needed to get as much stock as possible into the US before the tariffs hit. So they could basically defer the situation of accepting lower profits at the retail level or raising prices, which would have impacted demand. Asia, again, is down across the board with both Japan and China struggling. The other thing of note that is worth looking at is FH's dive into price segments. In simple terms, the cheapest watches are having the worst performance. Anything under 200 Swiss francs is in decline. Watches above 3,000 francs, which isn't exactly a big number considering how expensive watches can get, are the sectors seeing the strongest uplift. And that's no big surprise. In real money terms, that's where a 39% tariff hits the hardest. So it makes sense that that's where most product was pushed into the US before the tariffs came into effect. Now, depending on how you look at it, you can come to different conclusions. Most brands seem to be indicating that the Americas and North America are good for business, but the numbers can also be interpreted as inflated because of front-loading stocks at the wholesaler level. China and Asia seem to be terrible in general. Other parts of the world are a bit all over the place. But I read it this way. I think there are essentially three kinds of markets that are behaving in three distinct ways. There are countries that currently have more or less stagnant economies relative to historical performance. That's some parts of Europe, and it's China. After decades of massive growth in China, and importantly, a massive expanding middle and upper class, China is just not racing ahead in the way that it has been. That means the Chinese are tightening their purse strings and are not spending money on watches as much as they used to. Then there are the emerging economies, and I'm going to guess Spain and Singapore and India and Indonesia and Brazil. These are countries where growth is relatively speaking impressive. And especially with the ones that are coming from a low starting point like India, there's an expanding middle class and upper class that has an appetite for luxury watches, and that's driving sales. And then finally, there's the US, which at best is a mixed bag. All the screams of doom and gloom for the US economy have yet to materialize. Breitling CEO George Kern has called it a high growth market. So have other CEOs, and Mike over at Christopher Ward has said the same. The US economy has been surprisingly resilient, but tariffs are definitely having an effect, and it's a negative effect on consumption. There's no denying that. Consumer confidence is objectively down in the US. The outlook at best is unclear, and that's a problem, because those kinds of indicators usually mean that people stop spending money on shiny objects. We have to cover tariffs a little bit as well, because by now we know that a lot of brands have raised prices, and all of them are going to if they haven't. George Kern said they would raise prices, Patek has raised prices by 15%, and Omega has raised prices as well. Then there's the gray market. This is the graph you've probably seen a million times by now. It's a crash graph that showed how Rolex and other brands hit an all-time high in 2022, and then they had an as steep decline afterwards. But there's something new going on. Look from around February 2025. No more decline. It's a small but consistent upswing for the last 7 or so months. Rolex, same story. Rolex is up 0.9% for this past year. Patek is up 2.6%. Omega is up as well. Seiko is up as well. On the other hand, LVMH, Richemont, most Swatch brands are down overall. Then there's the gray market price ranges. $0 to $500, down by 10%. $500 to $1,000, down as well. $2,000 to $5,000 is up 4.7%, and everything above that is up by about 1%. Now you have to keep in mind that the gray market numbers from watch charts include older references and models that are no longer in regular circulation. But it's still interesting. The FIH reported that the cheapest watches are the ones in the biggest decline. And here on the gray market data, the conclusion is basically the same. Swatch, Richemont, LVMH overall are trending down in the gray market, and to a large extent, this aligns with how these conglomerates are reporting their own numbers. And just like Seiko is up at the corporate level, we also see a small uptick in pricing and demand for Seiko watches in the secondary market. To me, it indicates that there are potentially two specific things in play. One, when a brand is in demand at retail or new level, it will also experience demand in the gray market. And conversely, you can probably assume that if a brand is in demand in the gray market area, it is probably also going to be in demand at the AD level. And two, it's the safe haven brands that seem to be driving the meaningful uptick. I said something about this in my tariff video. I had this theory that if things got tough, the most popular brands would be likely to get hit the least because they would experience customers flocking to them as safe havens. It's the Jeff Johnson effect, the name you know, so you vote for Jeff. And who are these safe bets? It's Rolex, it's Patek, it's Omega. Now, who are the bad bets? Panerai, Longines, Breitling, Blancpain, JLC, Hublot, Breguet, Lange & Söhne. There's more of them, but those are the ones I really took note of. And the reason they are bad bets can differ. I think Longines' drop can be attributed to the fact that they are having a tough time in Asia, where they have been heavily represented. That means there's stock sitting on shelves in China, and some of that stock is getting into the secondary market at heavily discounted rates. For Breguet, I just don't think they're selling much at all anywhere.
This French watchmaker gave us just about everything that we wear on our wrists, and yet the brand languishes. The brand, where is it?
Lange, a little bit surprising, but again, not really. They're phenomenal watches, but despite their efforts, they haven't quite been able to hit the same level of desirability as Patek. Lange is great, but their watches are often massively discounted. In that sense, they're not a safe haven in the way Patek is. Overall, it doesn't change what the data seems to indicate. Purchases are drifting towards the safe brands like Patek and Rolex, but it's not turning into a hot streak that's going to turn into a spike in demand that's a reflection of a hot global economy. There's also another interesting set of numbers that caught my eye. Watch charts indicates that the 2,000 to 5,000 band is where the increase in percentages have been the greatest in the last year. Again, remember the grey market index, which I've used, covers all sorts of models, including watches that are no longer available at retail. But the 2 to 5K range is where you can get a good used older Rolex or a good newer Tudor. You can also get a good newer Omega in this range. There's a lot of value in this space. And I talk a lot about the $1,500 to $3,000 space, often at new. And this, I feel, builds on my growing assumption that the value buyer is still there for some brands. 2,000 to 5,000, whether used or new, gets you a really good watch these days. And for me, it's the starting point for a more luxurious purchase. Above 5,000, JLC is tanking because they're too expensive for what you get and are not a strong enough brand. But Rolex isn't. Hublot is tanking where Omega isn't. It's the same logic. And one last thing about the grey market. Gold and two-tone is trending up more than steel when you look at the numbers. And that makes sense. People are just generally throwing more money into gold these days. So to the extent that a gold watch is priced correctly, it will tend to draw in more customers because gold becomes viewed as a more secure investment. So what does all this mean? I'm willing to speculate a little bit on this, and I suppose I'm very willing to speculate. It's kind of the whole point of the channel. I've got some theories about what all this is going to mean for you and me right now. Tariffs in the short term are going to mean a spike in US pricing of grey market stock, especially for desirable brands. Why? Because the retail stock just got 15% more expensive. Customers still want a Rolex, so in the short term, getting a Rolex will mean a push towards the secondary market, driving up demand, which drives up pricing. But I don't see this as a permanent thing. It will be a drift because of a unique set of circumstances. Over time, the relative price between MSRP after tariffs and grey will realign to a new normal. I think Swatch, Richemont, LVMH, and most of the others that pre-shipped big stock to the US are going to be stuck with excess stock in 6 months' time, leading to a massive drop-off in shipments in a year's time to the US. If the US continues on this path towards what right now looks like some sort of stagflation, it's going to be in even harder times because China is not going to be picking up the slack. Neither is Japan. If the US consumers tighten their purse strings, these brands are in for a bumping ride. And for you, it means, especially in the US, but also globally, that there will be deals to be had on pretty much any brand that is not hyper desirable. So apart from Patek, Omega, and Rolex, and maybe Seiko, I would put my money on deals from IWC and Tudor and a whole host of others getting better. You're not going to see a ton of steel Rolexes available at an AD. You're not going to get a deal on an Aquanaut. And then there's the last thing. Since 2022, and probably before, a lot of brands have focused on raising their price without raising the value of their offering. More expensive, but not better. Some people knock Rolex, but honestly, it's not their price increases that have been the most jarring. It was Hublot and Panerai and JLC and Lange and a whole lot of others. And I think there's a window of opportunity for these brands. FIH, the Swiss Federation of Thingamabobs, they show that people still want mid-priced watches. The grey market indicates that people still want good value deals. The world is likely going to have a lot of consumers that are a bit more stingy, but I think the opportunity is there for brands that succeed in offering more value at the same price. Not just raising the price, but improving the offering. It's now that Omega needs a new, thinner Metas movement with longer power reserve at the same price. It's now that Seiko should offer upgraded bracelets and clasps across the line at the same price as before. It's now that Panerai should stick to their current price, but finally stop using plastic parts and downgrading and using base level movements with stock finishing. Good products will sell. They should spend a teeny tiny bit less on marketing and upgrade the products. The time is now, because I think it's now that people are going to get obsessed with value. George Kern even said the same in an interview recently. He said the brands that add price but don't add value are the ones that are going to lose out. So those are my thoughts and musings about the watch market right now. Share your thoughts in the comments. What do you think is likely to happen? Who are going to be the winners and losers? Like, subscribe. Cheers.